Oh, it is Friday the 13th of February 2009. This is Brian Shannon from Alpha Trends, and we finished up here with a loss in the NASDAQ today. Slight loss, that is, down 14 cents, or about a half a percent. Volume was a little bit lighter today, so that's one positive to see. And we, did close the week above the 10, 20, and 50-day moving averages. Realistically, looking at the daily time frame, we remain trapped in this bigger range. And it was encouraging to see the rally on Thursday did hold for the most part. If we look at the 10-minute time frame, we had gotten above this little level and basically held right around there. So, where we got to, though, was right up to those declining 5-day moving averages. And early on in Twitter, I said that I thought it was going to be a choppy day. And the reason I thought that was because we had expended a lot of energy yesterday afternoon. Nothing's been fixed as far as our economic problems, and we were just below this declining 5-day moving average. So, again, we remain, in a longer-term bear market up near the high ends of a recent range. Nothing to get excited about as far as the bullish scenario goes. We do have some encouraging signs, but not enough to be an investor on. That is not enough evidence there to be an investor. Next week, we're going to continue to see this level to be very important, right around this 2960. If you remember, that's also the two-thirds retracement, approximately down to 2940, actually, of the lows from January to the highs that we've seen so far this month. So we're below a declining 5-day moving average. You've got to be very careful. We're also below this prior level that's been important as well. So this area, this $30.80, is significant to the market as far as it being a level where sellers reside, and we've got an important level of support not too far away on the downside. On a 10-minute time frame, I think this low is going to be important at about $30.30. Then we have the next level that this market could drop down to and test that area. As far as the 2-day VWAP, so basically you're looking at this chart, that's the gold one. This is the average price of the last 2 days. So the buyers did maintain the control for 2 days at least here. And that's as long as they've been able to for really much time at all. Here we've got a 5-day VWAP moving average as well. So, for the week, basically, the volume weighted average price was right around here at about $30.50, or a little bit lower than or a little bit higher rather than where we closed. For the year, if we keep an eye on where we are in relation to the average price paid for the NASDAQ 100 this year, it's about $29.90. So still a lot of uncertainty out there. If we can get above, and then I'd say and hold above $30.80, then perhaps we can go back up to the top end of the range, which is found at about that 31 and a half. Actually, I'm sorry, 31.80 or so. Back to 31.80. So we've got this level. If we get back above there, then we'd put a test of that, and maybe this is setting up a cup and handle. We'll see. You don't want to be looking solely at the potential bullishness, obviously, because the market still has a whole lot to prove here. The financials today, the financials were down 35 cents, so they continue to be where the real weakness is. This trend line, it's still holding somehow, but 855 or so, getting below that, then I think you're pretty much almost guaranteed a test of these lows at a minimum, and perhaps lower lows. We have this little triangle forming. In a bear market, it's typically going to continue back to the downside. On the 30-minute time frame, we had seen again that this $9.40 level that was tested and held as resistance this week. So that level continues to be important. We've got these little support areas, very short-term support levels or levels of potential support where we may bounce from. But even for the week, though, we still have this pattern really of lower highs and lower lows. It started to neutralize in here a little bit today, but for the 2-day VWAP, the banks did close below that. So in spite of this big volume rally here yesterday afternoon, the average price paid over the last 2 days was a little bit higher than where we actually finished up for the week. On the 30-minute time frame, again, we've got this downtrend line. The biggest level is that $9.40 area, and of course, you can see the market fell pretty, well short of this declining 5-day moving average in here as well. So the banks remain a mess. The biggest level, near term as far as the resistance has been, remains at $9.40, and path of least resistance obviously is lower. Oil was up today and this USO was down, so there's a lot of people talking about the contango and this and that, but if this thing's going down, you just simply don't want to buy it. It's in a downtrend. Stay away from it. And the ETF obviously gives it more reason for concern. The semiconductors, that is the lack of correlation to the actual oil commodity, gives you more reason for concern when trading that. Semiconductors we'd seen are making these little higher highs and higher lows, but realistically we remain within this range here though. So it's looking good as far as the higher highs and higher lows, and these are good tradable rallies. Now in the 30-minute time frame, we're getting up to this 1860 level again, and if we can get above there, that's going to be similar to the level in the Nasdaq, which is at about $30.80. So these semiconductors, 1855, 1860 remains important. We got basically rejected here by the declining 5-day moving average today. They were up 17 cents, but again, the point here is when this 5-day moving average is declining, in particular when we're in a bear market, you want to be very cautious about any longs. And after a large rally like this that expends a lot of energy, you're typically going to see some consolidation in there at best case, if not a reversal. So breaking back below this level at about $18.05, let's call it, getting back below there, then I think that then this trend line will be tested, and we'll be looking at that 1750 level once again that did hold this week. So that was the encouraging sign this week. But 1805, this little resistance should act as support if this market is going to continue higher. But again, when you've got a weekly time frame that looks as bad as this and maybe more neutral than anything, it's tough to trust. Those consolidations within an overall downtrend typically resolve themselves in the direction of the primary trend, which is of course obviously lower. So 1860 is an important level as far as potential, as far as resistance, that if broken and can hold above next week, that'll be good for the market. And then back below 1805 or so, $18, that could lead to a bigger breakdown towards this trend line, and then who knows, then maybe we go back down towards the low end of this recent range here. The Russell 2000 was down 47 cents, and this market continues to really be the laggard. It's stuck below the 10 and 20-day moving averages. The 10 and 20 are below the 50. We've seen that these trend lines, this market really breaking back below here once again, I think could be a very difficult time for the Russell 2000. It really is probably the least potential for a bullish rally at this point. Of course, that doesn't mean you can't just blindly be short. The key level in here again, if we break back above $46 a share, then if you're bearish, then I think that you gotta pay attention to what the market tells you, and basically what the market would be telling you above 46 is that it's just not ready to break down further, and maybe it's going to go back up towards the top end of that range near about $47.60. It does though really it's rejected at the declining 5-day moving average. When that 5-day moving average is declining, you can see it wasn't rejected just once, but it tested it right here, it tested it again, and then fell short late in the day before closing right near the lows of the day. And basically it was a very choppy session, like I had mentioned early on in this video. So right now what we want to see from a bearish perspective is, I think, breaking this level here at about 43.5 and then 43. Breaking those two levels, it just seems pretty easy to me that we continue down towards at least this level or so. Very similar to the way the IYR continues to be very heavy. It really, this is the real estate index. I've been talking about that in the second video a lot, but there's a lot of pressure in there, and the Russell 2000 seems like it's basically got the same chart but a couple days behind. Back above 46 though, I think you gotta reconsider the breakdown scenario. Let's take a look finally at the S&P 500. It was down 90 cents today to 82.76, or down 1%. We'd seen a little initial rally here and fell short of the declining 5-day moving average. The market pulled back, made a higher low in here, but then made a lower high below the declining 5-day moving average again. And late in the day, we saw the sell-off, down to 82.76, and I'm looking right now, it's trading 82.53 in the after hours. It's a long ways till Monday. I wouldn't pay too much attention till that. It's a long ways till Tuesday, rather. We've got a 3-day weekend, but the S&P 500 remains similar to the Russell 2000 in terms of how it looks, and I think that breaking 81 then puts this $80 level in jeopardy, and from there we could see a quick and fearful decline. So, what would negate that right now? I still think that probably, right here we've got a little bit, maybe getting above 84.5 or so, then we can get a little bit further bounce. But we've got these bigger levels at 86. So we've got this area right here from these highs that is right at about 85.30 or so. So it's tough to make a bullish case in here. You gotta just remain defensive always.